Good morning, everyone. Welcome to BDO Back to Business webinar series, the session 2, which is on all of the recent COVID-19 tax reforms. For those of you who don't know me, my name's Iain Craig. I lost my eye to a cancer lump about 6 years ago, and that gave me the perfect excuse to adopt a byline of being BDO's Eye on Tax. And today it's my pleasure to bring to you a seminar on these tax changes. But I'm delighted to welcome my good friend and colleague from our Christchurch office, Mark Lodder, to assist me with the presentation. Mark, do you want to say a few words?
Yeah, thanks, Ian. Morning all. Just a very quick hello from me. I'm here to help Ian with the Q&A session, and I think I have a starring role in one of the topics. So I'm going to pass back to you, Ian, to kick the slides off, mate.
Thanks, Mark. I hope you're ready for that starring role, because I'll need you. Can I have the next slide, Charlene? So we've got a lot to get through today, and one of the benefits of this presentation format is that I don't need to start my presentation with the usual health and safety announcements, you know, where the emergency exits are and where the toilets are. But I do have to warn you that there is technology, and if something goes wrong, we've got some people behind the scenes who will make sure we get back online straight away. But hopefully, with the last 2 seminars we've run, there hasn't been any technology problems. So what we're going to do is spend about 30 minutes going through the set of reforms shown in the agenda. I'll deal with the social and financial assistance, just a brief overview of those, but I concentrate on the wage subsidy. We'll look at the IRD's policy on remission of use of money interest and late payment penalties. And Mark will come in with a starring role for the tax losses reform. I'll pick up in some of the other incentives that are still available to try and assist your cash flow in dealing with the tax, and some tax administration changes. We have a Q&A forum for the remaining 30 minutes of the session, and I'd ask you to lodge your questions and answers in writing through the chat box facility that should be available on your screen, and then Mark and I will try and address all of those questions. And while we might not be able to get through all of them, we'll do our very best to answer those questions, and if we can't get through them all, we will update our COVID-19 microsite with those responses. So moving on, please, Charlene. So there's a suite of reforms arising out of COVID-19, which I've regarded as financial assistance forms. If we look at the left-hand side of the screen, there's the introduction of the bank guarantee scheme. This is where you apply to your bank for a new loan to cover some of the problems you're having with cash flow as a result of COVID-19. And once it's registered, the government will guarantee 80% of the debt as security, and that so it's a government-backed guarantee scheme, but you'll still be liable for the guarantee and cover the security for the remaining 20% of that bank debt. And that's available to businesses that are with a turnover over between $250,000 and $80 million. On the right-hand side, and a slightly different tack, is the recently announced Small Business Cash Flow Loan Scheme. Now, this is a loan scheme that is being offered and administered by Inland Revenue, and it provides where Inland Revenue will pay $10,000 to a business and $1,800 per full-time equivalent employee in the business. And this is available to businesses who employ up to 50 people. So the maximum amount of the loan is $100,000. So you've got $10,000 up front plus $1,800 at 50 employees. That would get you to the $100,000. Up in the top right, in the middle, is the Regional Business Partner Funding Program, and this is a assistance for you to get up to $5,000 to help pay to get professional advice from your business partner. So this could be in the nature of contacting BDO to get some strategy advice, extra cash flow forecasting, and dealing with some of your business plans going forward, but it could also extend to HR, well-being of your employees, and or IT things. You apply through the appropriate regional business partner, and that in Auckland that's ATID, and you can find a lot of this through the websites. I had a look at it, and through New Zealand Trade and Enterprise website, I found that quite a useful website as well. And I'm sure there's a link in our COVID-19. Company Act has also been reformed, and there's some legislation in play for that. And this is to provide directors with a safe harbour of 6 months where they can be protected from action being taken against them for trading while insolvent. That's quite a serious accusation, and I think the safe harbour provision is designed to give a director a little bit of protection to still make a decision to carry on trading, provided that they make that decision in good faith, that they were able to pay their debts as they fell due at 31 December 19, and have a reasonable expectation that as trading improves, they will pay those debts over the next 18 months. There's also a debt hibernation scheme being introduced, and various other company law administrative measures. The last box I've entitled Financial Assistance is the Inland Revenue's proposal to relieve use of money interest and late payment penalties, and I'll deal with that in more detail later. Charlene, next slide. Yeah. So in the social assistance side, there's been also a suite of measures, and and obviously the first thing that was increased was benefits. The winter energy payment has gone up as well, designed to make sure that people who need to stay warm are able to stay warm even when they're during winter. And to quote a famous TV program, winter is coming. There were provisions brought in to protect tenants for when they couldn't afford to pay their rent. Application to enter into a mortgage repayment deferral with your banks, and of course the wage subsidy and leave support scheme. So let's move on to the wage subsidy. This is these are the buzzwords that really encapsulate some of the issues that are going on with the wage subsidy. So who is eligible for the wage subsidy? So this is any New Zealand registered business who legally employs people in New Zealand, and legally is one of those terms. So you can't be employing people illegally, for example. But if that business, the employer business, has suffered a 30% decline in revenue over 1 month, essentially 1 month since January 2020 through to June 2020, they can apply for a wage subsidy, and that decline in revenues compared against the same month in the previous year. And that entitles an application. You make an application listing your employees, and they will be entitled to $585, or if they're full-time employees, or $350 per employee if they're on part-time hours, for a 12-week period. Now, as part of this process, you file a statutory declaration, and part of the statutory declaration is that you agree that you have undertaken moves and factors to try and mitigate the impact of COVID-19. This will be including looking at your bank, approaching your bank for additional funding to keep paying the wages, looking for any business interruption insurance that you may be able to have, and any other similar factors that you can do to mitigate those impacts. But the statutory declaration is also very important because it clearly sets out the obligations you take on as an employer in applying for this wage. You, aside from the usual, you've not provided any false or misleading information in making this declaration. It requires you to continue to pay that employee subsidy, the wage subsidy, to the employees for that 12-week period, and undertake to continue to retain them as employees during that period and pay up to 80% of their wages. Now, there's two forms of statutory declaration. There was the early declaration that had to be came out when, if you applied before 4 p.m. on the 27th of March 2020, and then those rules were sort of clarified, and a new statutory declaration came in on the 27th of April, at 4 p.m. actually, on the 27th of April 2020. So if you are looking at a situation where you may have to repay some of the wage subsidy, it's important that you compare it to the right statutory declaration and which one you applied for. But yes, there's been a bit of press in the paper, a bit of press around companies who are listed in a public website and being asked to repay the wage subsidy that they've applied for. And there are circumstances in which you are required to repay. Now, one of the first ones would be if you applied for the wage subsidy expecting your revenue to drop by 30% in, say, March or April, and you did not suffer that decline in revenue, then you're obviously not eligible for the wage subsidy because you didn't have that decline in revenue. So that would be one obligation to repay. Other obligations are if you end up making some of the employees that you've applied for redundant, then you can use the wage subsidy that applied to that employee to pay out their notice period. But any balance that's left over needs to be repaid to the Ministry of Social Development. Now you can contrast that with an employee who voluntarily leaves your employment. If they voluntarily leave the employment, then you're not required to repay the balance of the wage subsidy, but can retain it to keep with your continue to deal with the effects of COVID-19. So other situations where you may have to repay would be as if you've received business interruption insurance to cover some of the costs of COVID-19, or if you've simply no longer eligible because perhaps you've made a false or misleading statement in your application. But I think the biggest one would be that the revenue didn't decline as you expected. Move on to the next slide, please. This is a snapshot from the Inland Revenue's website, and I'd like to just read those first couple of sentences in the bottom right-hand corner. This is the announcement from Inland Revenue, which was made very early in the COVID-19 response. If you're unable to pay your personal or business taxes on time due to the impact of COVID-19, we understand. You don't need to contact us right now. Get in touch with us when you can, and we'll write off any penalties and interest. Well, this was an extraordinary statement made very early in the piece, and it certainly gave the impression that all penalties and interest would be remitted by the Inland Revenue. And you know, the amazing thing was they didn't want you to contact them straight away if you couldn't make the payments. But since that statement, we've now had legislation introduced, and which is in the next slide. So we've got a new section 183AB of the Tax Administration Act. I'm sure you'll all remember that section. But this is the section that gives the Commissioner now the power to remit use of money interest. And just to set this in context, the Commissioner has never had the power to remit use of money interest, has the power to remit late payment penalties and even remit shortfall penalties as well, but they never had the power to really remit or not charge you some money interest. So if your ability to make payment was adversely affected by COVID-19 and the tax payment fell due no earlier than 14th of February 2020, then you can ask the Commissioner of Inland Revenue to remit the interest charged after that date. And the Commissioner will remit that if they are satisfied that you've asked for the relief as soon as practicable, you make the payment as soon as practicable, and no more than 24 months has passed since 25 March 2020. Now, this time frame, the 24 months, may be extended as powers for the Commissioner by order of Council to extend that time. And the reason it's the 25th of March 2020, not the 14th of February 2020, is that is the 25th of March was the date that this section received royal assent, or the act that brought this section in. So the key things here are your ability to make payment had to be adversely affected by COVID-19. The due date had to fall after 14th of February 2020, and you have to go through the process of asking for remission. We've got a couple of examples coming up to highlight this. So example 1, ABC has a 31 March balance date, standard New Zealand balance date. Its 2020 provisional tax due dates were 28th of August 19, 15th of January 2020, and 7th of May 2020, today actually. It paid its P1 first instalment on a prior year uplift on 28th of August, but was late paying P2 due to being away on an overseas holiday. And that's just my sly dig that I always get very frustrated with trying to organise P2 instalments for 15th of January 2020 when half the clients are on the beach. ABC is struggling to pay P3 due to COVID-19. So can ABC get remission of the use of money interest or late payment penalties? So what is interesting about this example is that normally if you are paying your provisional tax on a prior year uplift basis, you're not liable to use the money interest until at least P3, the third instalment date. But because they were late with paying the P2 instalment, use of money interest will be imposed from those earlier dates. But for the third instalment of provisional tax, which is the 7th of May, that will clearly be eligible because it is due to fall. That due date has fallen after 7th of February. So it is possible that if you've been affected by COVID-19 and you don't want to make your provisional tax payment today, you could leave that to run and interest will be charged, but you can seek relief. And the key thing was, well, if the revenue decline your remission application, which they might do if they say it wasn't affected by COVID-19, if you haven't got enough of a nexus to the COVID-19 impact, then you would use tax pooling in order to mitigate the use of money interest at that later stage. Example 2 is a slightly different example. It's to do with 2019 terminal tax, where the taxpayer, the DAF company, has $65,000 to pay. Had $65,000 to pay on 7th of April 2020, but couldn't meet the payment due to COVID-19. Now, in this case, the provisional tax dates were all well before 14th of February, and the use of money interest has been charged from 28th of July 2019, and that sort of indicates that they weren't in any safe harbour. So in this example, DAF would not be able to get remission of the use of money interest because the use of money interest relates to underpaid provisional tax due through to the period, and because they weren't in a safe harbour regime in those earlier P1 to P3 instalments, perhaps because they estimated their third instalment, for example. So there are limitations on that remission, and as we move into the 2021 year and 21-22 year, those intricacies will drop out because clearly all of the payment dates will be after 14th of February 2020. So next slide, please. I think this might be passing to Mark.
Yeah. Thanks, Iain. I was just thinking about your section 183 AB. It's such a shame it wasn't ABBA, but anyway, back to tax loss reform. This one's a really big change, very important, and has created a bit of excitement in the tax world. So look, first off, I'm going to say that we welcome it, but we are going to talk about some of the casualties. So the tax loss carryback reforms are within the COVID-19 Response, Taxation and Other Regulatory Urgent Measures Act. It is now an act and urgent by name, urgent by nature, urgent by name. It received royal assent on the 30th of April. So it is law. The law we have is temporary, and we are expecting permanent changes to be out for public consultation later this year. Because it's temporary, we're only looking at losses in two tax years. The two relevant tax years are the 2019-20 or the 2020-21 tax years. Tax losses arising in these years can be carried back to offset the profits of the preceding year. It's a one-year carryback only. It's not difficult. The slide shows it's not difficult in concept. There are some peculiarities. Some of the things that we need to think through: balance dates. Balance dates are going to play a part in determining in which year the tax losses arise. So if you have an early balance date between 1st of October, 31st of March, you'd assume that the effects of COVID-19 would be expected in the 2020-21 tax year. For your late balance dates running from the 1st of April to 30th September, we're probably going to expect the impact of COVID-19 to hit the 19-20 year. This initiative is about getting cash in the hands of taxpayers quickly, as is all the other reforms as a rule. So these rules allow businesses to estimate losses. Okay, that's a really important point. You can estimate your losses and carry back estimated losses. It's open to all business types, and it will include it does include groups of companies, but the chosen structure does mean that the rules can have their limitations or casualties. So if I just run through a couple of the big important ones here. If we think about companies in particular, closely held companies, ordinarily we look to pay shareholder employee salaries, which will result in that closely held company moving to a break-even position. So it might have been profitable, but we move the profits as a shareholder employee salary to that person, individual. Therefore, the company has no profits. The tax is in the hands of, or the tax is paid in the hands of the shareholder. Therefore, if we have tax losses in the subsequent year, we have no profits to carry back the losses to. Inland Revenue released something yesterday, this morning, regarding this position, and they have confirmed that it is a casualty of the rules. They're not going to allow an adjustment to shareholder employee salaries. So that does mean that there's planning to be done here. So you might want to turn off the shareholder employee salary payment. You might want to look at the shareholder employee who's paid provisional tax on the basis they were going to get a salary in the 2020 year. If they have paid provisional tax, you're going to be looking to make an estimate to recover if the company is looking to claim a loss carryback. We also think that these estimation rules are going to probably encourage a delay in filing the 2019-20 tax returns until late as possible, so you've got more certainty with estimated losses. It also does beg the question of those running with an early balance date. Have you missed your opportunity to plan if you've already filed, paid and dealt with a salary, and you're not allowed to unravel it? The other major casualties around your dividend paying companies. No different to the existing rules. If you haven't got imputation credits, then you can't be refunded any tax that you've previously paid. So if the company's paid a dividend and utilised all imputation credits, then yeah, okay, strictly speaking, you can carry that loss back, but you're not going to get a refund. Now I'm just going to talk about a quick trap, and that's to do with the shareholder continuity requirements. We have shareholder continuity, and I'll talk about that in a bit later on with respect to losses. But normal rules are, or the rules as they currently stand, is a company can carry forward tax losses provided it's met 49% shareholder continuity. The tax loss carryback rules say that you have to have maintained shareholder continuity from the beginning of, or the start of, the profit year in which you are looking to or push those losses back to. And this is to prevent the use of losses to eliminate tax on income that was not connected with the loss-making business when it was earned. Thinking it through, there's possibly a little bit of or a lack of consistency here, certainly when you consider shareholder employees. So shareholder employees are connected with the company, but if you've paid the salary, we can't do anything about it. But if you're not connected with respect to the carryback of losses, then you're going to lose out. So those are the major casualties and a trap. The other thing to talk about in terms of loss reform is that we were expecting rules on the carrying forward of tax losses and the introduction of the same or similar business test. We do expect this to apply for the 2020-21 income year. We just don't have it in a bill at the moment. It is coming. It just didn't make the cut for this bill, which is probably a good thing, because it means that we've got agility and we can start moving these important changes through quickly. So I think that is all I have to say on tax losses. So I'll pass back to you, Iain, please.
Yeah, thank you, Mark. Yeah. So just run through the last few slides quite quickly, because we're wanting to get on to question and answer session. But other things that moved quite quickly was the reintroduction of depreciation in commercial buildings. You're now going to be able to claim 2% DV or 1.5% straight line from the 2020-21 tax year. Some of you may remember that depreciation rate on commercial buildings, or all buildings, was reduced to 0% after budget 2020. So at the end of the 2010-2011 year, sorry, getting all my years mixed up. So if you owned a building back then, you should have an old adjusted tax book value, and you can restart the depreciation from that date. And if you've acquired the building since then, or in both cases incurred some non-deductible capital improvements in the period in between, you'll be able to capitalise those and depreciate them. And just watch out for an impact for those accounting for deferred tax in your financial statements. A quick move that came in the 17th of March 2020 was to allow you to write off assets which cost you less than $5,000 immediately. This is the old low value asset of which was $500. And I just jokingly say that $5,000 was about the right cost for setting up a home office so that all your staff could work from home. It's going to be reduced to 1,000 as a threshold come 17th of March 2021, unless it's subsequently changed. And this little trap with this one was that you're not allowed to buy in bulk. So if you go out and buy 10 computers and printers for $4,000 and get one invoice for $40,000, that doesn't qualify for that write-off. Next slide, please. I want to emphasise that there are two research and development tax incentives in play at the moment. The traditional R&D tax loss credit, where if you've incurred tax losses and you incurred eligible research and development activities and you met a certain wage intensity test, then you were allowed to cash up to 28% of those losses depending on the formula. And that regime's been in for a number of years, and so many of you may be familiar with it if you're in that space. 2019-2020 year is the first year of the research and development tax incentive, and it's a 15% tax incentive based on eligible expenditure on specific activities. It's a slightly higher bar than the R&D tax loss credit. There's a different set of rules for it. But actually both regimes are in play. So if you are in the space of R&D, you may be able to claim under both regimes. They are not mutually exclusive. And the reason for that is that the R&D tax loss credit is really essentially a loan to the company that's carrying on the R&D tax credit. And if you have an event where you sell your IP or you start to become profitable, that tax credit is clawed back over time, or in the event of a sale. Whereas the R&D tax incentive is a straight out and out tax credit incentive. Year one was supposed to have a very limited refundability that only applied to companies and had a cap at of up to 255,000, I think. So they've moved to broaden the refundability, so it applies to all businesses that are taking up R&D tax incentives, and the refundability is now based on the amount of PAYE and FBT and sort of payroll taxes that you pay in relation to R&D activities. So it's both of them quite complicated regimes. The one difference as well is that with the second regime, the R&D tax incentive regime, if you've enjoyed a certain Callaghan growth grant or innovation grant, then you may not qualify for the R&D tax incentive. But if you are qualifying for it, it would be good to look to prepare those claims early in order to boost your refunds. Next slide, please. This is really just the last slide. So there was a number of other changes to thresholds. So provisional tax gone up from 2,500 to 5,000 to try and remove a number of taxpayers from provisional tax. They relaxed a number of filing deadlines to 31 May. And this was relevant to things like, so you file your tax return, you can still make a subvention payment, provided you make it by 31 May. Subvention payment is where you pay for the losses of one of your other group companies. You can run your stock take during May, because maybe you weren't allowed to do a stock take because of alert level 4 at 31 March. But it didn't extend to beneficiary distributions out of your trusts. So if the money wasn't paid or applied to the beneficiary before 31 March in respect of the previous year, then the income will be retained as trustee income and taxed at 33%. There's also some helpful commentary on the Inland Revenue's website on GST issues, what to do when you had a cancelled supply that wasn't able to be delivered, whether businesses should think about deregistering because their turnover has dropped below 60,000. But probably the most important one was allowing the provision to extend the time period to be able to enter your goods into for export out from the previous 28 days to a 3-month period. On a similar keeping, you've got the tax residence. There are people who are being stuck in countries that they don't intend to be stuck in. And tax residence is often determined by whether a person has spent more than 183 days in a 12-month period in a country. And so those rules have been essentially relaxed, or the days test will be ignored for the purposes of residence, because we don't want to tax somebody as a tax resident simply because they've been trapped in New Zealand during this period, and likewise Kiwis caught in other jurisdictions overseas. There's one last one which I forgot to mention, and I haven't got this slide, and that's the recent announcement around certain working from home allowances that you can pay to employees, which would be tax-free, and there's a safe harbour of about $10 a day, and I think maybe $400 for allowing staff to buy some furniture to help them set up their home office. But I think there's quite a wide range of reforms that we've covered, and I think we'd like to move to the question and answer session now. And Mark, have you got a question you'd like to take over with?
Yeah, no, thanks, Ian. I'm just looking through them now. There's some good, there's a good bunch of questions coming through. So if I'll start with the first question. The first question: what is the capital of Turkey? Oh, hang on, sorry guys. I'm still on a pub quiz here, but a virtual pub quiz. So let me just get to the right slide. Oh, here we go. Right. I'll go with my favorite question at the moment. Then looks like it's come from Barry. The question is, what's missing? What else do we need changing? I think that's a good question, because there is a lot of reform out there, and a lot of and welcome reform, but it's never always complete. And I'm just thinking back to the days when we were working through the aftermath of the Canterbury earthquakes. And from our experience, one of the big issues that we were finding was with regards to deductibility of expenditure incurred by businesses that have had a more than temporary closure. So if you've got a temporary closure, then normally you can still claim your deductions. You still have your nexus to income. However, if your doors are shut on a more than temporary basis, you can't claim your deductions. So I'd quite like to see something along the lines that we had as a result of the earthquakes, and this is a buzzword again, but effectively the costs are hibernated. So you do get a deduction for costs, but they become deductible as and when the business resumes. So we don't lose them. We've had a quick discussion with policy on this, and we understand it's certainly not the intention that businesses won't be able to claim their deductions. So we are expecting a change in this regard, but we just haven't seen anything yet. What about you, Iain? Have you got anything?
Yeah, sorry, thanks. Just waiting for it to transfer over. Yeah, look, I one of the ones I'm kind of interested in, and this question came up at the last seminar, is around the FBT on motor vehicles during lockdown 4. And Inland Revenue have posted their response to that question on their website. FBT in motor vehicles is based on the availability of the motor vehicle for private use, and if they're having the car at home, it's potentially still available for private use. But if you can't go anywhere, that's really quite restrictive. And even if the company as an employer has written to them and restricted their private use and suggested they've got to use their other cars that are available, the revenue are not necessarily accepting that position at the moment. However, they have said that they are looking into it, and that would be one reform I think would be far easier for them to just rule that the days during lockdown alert level 4 should be excluded altogether from FBT. It would be such a simple change to make, and it would just take all that uncertainty out of the FBT return. They've still got time. They realise that the FBT return to 31 March 2020 is due for filing on 31 May, so I would watch this space in that. The second thing I'd like to see the Callaghan grant being extended for a few more years, because I think there's a lot of smaller companies doing really good innovative things, which may not just may not be of a size that the complex R&D tax incentive scheme is going to more easily reward, and whereas the Callaghan grant was kind of a apply for it, get the cash, and go on with your business. So there'd be two things I'd look at. Sorry,
Iain. I'm just looking at another question here. A question's come up. How does the 30% decline work for businesses that were investing in growth, adding positions and investments, etc.? Understood it was a reference to projected losses. So this is clearly a question around the wage subsidy. I think we've got to be really careful with the wage subsidy, and it's the rules are based on not projected losses but projected turnover. So it's around your turnover, and it's largely, well, it's irrelevant that the businesses are investing in growth and adding positions and investments, etc. The rule is around, has your business experienced a 30% decline in revenues or anticipated revenues? And don't forget, I think Iain mentioned it earlier in the presentation, if you are claiming the subsidy on a projected 30% decline that doesn't eventuate, then you're not able to keep the subsidy. It's a payback. So I think that's a good question. So don't focus on loss, focus on the revenues. Iain, is there anything in there that you can see?
Yep. What I would say, there's also that provision in the eligibility around fast growth companies that then have a decline in revenue post that growth, and they may not have the comparable period. Last year the month might be different, so there might be a little bit of leeway in there around that that application. There's a couple in wage subsidies while we're on wage subsidies. So how is the wage subsidy received, treated in 31 March year-end accounts for income tax purposes? This is for both wage subsidies received prior to 31 March and wages obviously that paying out after 31 March 2020. So apologies, I should have mentioned that. The wage subsidy, generally speaking, if it's received by an employer and a company, is tax exempt to the company receiving it, and the payout to the employee of the wage subsidy is non-deductible. It's taxable to the employee. Now, if you're in self-employed, then it remains taxable, but you spread it over the period of the 12 weeks. So hopefully that answers your question. Do you think the IRD will revisit the ring fencing of rental losses and LTCs? Great question. No. Certainly there's been no discussion, nothing to say that they're going to do it. We have
Iain, just on that one, I think it's pretty clear in the loss carryback as well that they've excluded a carryback for residential rentals. So that gives a bit more of a flavour again as to how residential rentals are perceived.
Yeah, great question.
Okay, there's another one here on tax pooling. So will the Inland Revenue likely allow tax pooling for taxes other than provisional tax? That's a good question. At the moment, tax pooling does extend to other taxes, but only where we've got a reassessment. As it stands, I haven't seen anything out there where we're in a situation other than reassessment that will allow pooling for anything other than provisional tax, income tax. Iain, have you seen anything on this one out there?
The examples that have been provided that I've seen were focused on provisional tax, obviously, but in my view, that they have clearly, with their early statement, said if you have trouble in paying the tax, we want you to still file the returns, and that would include the GST return. And we want to understand what level of debt is there, and I think there will be application for remission, because the section 183 ABAB, although I did like your ABBA joke, it clearly isn't restricted to income tax or provisional tax. It's any tax payment. So I think there'll be chances for relief there. But whether they'll let tax pooling, I think you'll just actually apply for remission from the relief of interest and penalties in that case. There's so many questions here, it's quite hard to pick up all the right ones. I think there was one here about if somebody's taking out voluntary redundancy and one is shown interest, does that count as a voluntary choosing to leave the employee and to have to repay the wage subsidy for this employee? That's a really interesting question. I don't think voluntary redundancy would qualify as voluntarily leaving if you're making them redundant. That test would be about the position being disestablished. You use the wage subsidy only to pay the notice period. You cannot use it to pay other contractual redundancy payment obligations that might exist. There is the guidance that we have here is just in terms of frequently asked questions issued by Inland Revenue or WINS. So the legislation around there is no legislation around what when it's paid in terms of redundancy versus the other matter. Mark, any other ones that you're looking at?
Yeah, there's a question from Graham here, and I'd love to know the answer to it, but I'm going to say it anyway. So if a business splits off part of its business and the remaining business undertakes the same business, would this still qualify for the shareholder continuity rules for past tax losses under the same business test? So look, this isn't we don't actually have this in the Act. This is being put forward. The same or similar business test is something that's been put forward as a proposal. Like I said, we do expect this to find its way into a bill imminently. When these proposals came out, they were very clear that the same or similar business test is based on the Australian rules. Now, we don't have anything more than that at this stage. We do know that the Australians relaxed their rules. I think it was about a year ago. It might have been early March 2019, where they removed the word same from their test and just relied on the word similar, on the basis that same is a bit restrictive and loses flexibility. It's a brilliant question, and the answers are going to find its way out. You'd like to think that yes, you would still meet shareholder continuity on the basis the business is similar enough to allow those losses to be carried forward. But that's a really good question. I'd love to be able to give you the silver bullet answer here. As and when we get legislation, commentary, law, we'll know where we're headed, and of course we can delve into the ATO and experiences from Australia. So thanks for that one, Graham. Yeah, I quite like that one, Ian.
Yeah, I think the same or similar business test is probably one of the most exciting changes in our tax loss rules. Jokingly, since the mother of all budgets in 1991, and I'm old enough to remember that budget, when they introduced the current shareholder continuity rules. So the fact is, we've had umpteen opportunities to be able to introduce a same or similar business test. It's not an unusual test, and they've always rejected or never adopted it. So it's interesting that it's now got some traction in this COVID-19 environment. Another question here, and this is there's a couple of questions where I don't know the answer, but I'll read the questions because I think they're interesting questions, and what we'll do is we'll respond to them on the frequently asked on our COVID-19 update. So we've been aware that Class 4 gaming trusts who've provided grants to organisations for salaries may be going to ask for repayments when the entity has now received the government wage subsidy as well. Are you aware of this? And if so, can you update what you know? So I'm not aware of that development. And so I really don't have much to update you, but I guess there'll be, maybe there's some conditions around how that gaming trust and the trust deed administers their payments. And so first start would be to look at the basis on which that grant has been made. You know, the wage subsidy doesn't cover all of the salaries and costs of organisations. It's only a small amount that they can pay to cover a little bit of wage. It's only $585, and many people are paid more than that. Obviously, there's some in other industries where it's less. Mike has asked the loan in terms of the bank guarantee scheme, the loan up to 80 million. So that if you have a company in your group less than 80 million turnover, but total of all companies in the group is more than 80 million, can you get the loan? Look, I bow to have a look at our COVID-19, and the bank guarantee scheme is outlined in that area. I would have thought each company is taken on its own right, but perhaps one of our business advisory partners or insolvency partners can deal with that in one of the other sessions, but we'll certainly update that in our frequently asked questions. Mark, any others for you?
Yeah, I've got another good one, and crikey, we did an awful lot of work on insurance and tax issues on insurance a few years back. But the question is, you mentioned that company may have to repay the subsidy if there was an insurance payout after the claim was made. And I think the question is really around the insurance and whether or not it's taxable from taxable income. So when we're looking at insurance, we largely, in terms of working out the taxation consequences of that receipt, we look at, from an income tax perspective, we look at what is the insurance replacing. So if it's replacing profits, then it's taxable. If it's an insurance receipt for a subsequent expense that would then be deductible, it will be taxable. So I think based on this question, it's very highly likely that the insurance receipt would be taxable income under income tax. The other angle to watch out for is GST. So if we receive an insurance payment in respect of a taxable activity, then that's subject to GST as well, unless, and this is very broadly, unless the insurer is overseas and isn't a GST registered person, and that can change the rules. But that's a really good question, because there's an awful lot on insurance, and it's commonly missed or misunderstood. So that's one that's jumped out for me.
Yeah, thank you for that. And I've just quickly looked at the rule, and what it said is you need to repay the COVID-19 wage subsidy where you've received insurance for any costs covered by the subsidy. So you'll need to look at the terms of your insurance policy, and if you do get a business continuity insurance, is it covering the costs covered by the subsidy? And of course, that would be the wages. I saw a couple of questions again on wage subsidies. If the application for wage subsidy was based on the expected 30% loss in revenue in April, but the decline didn't happen in April, but now anticipated in May, do we have to repay the subsidy, or do we retest the eligibility based on May or June? So the answer to that question is no, you wouldn't have to repay it, but you still have, because you still have an ability to, it's just 1 month between 30% decline in revenue between January through to June. And even though this was announced in sort of March, the reason that January is there is that there were some businesses that were affected by the impacts of COVID-19 on export markets. So take the forestry industry, where the logs were not able to be exported to China because of the lockdown and the borders there. So in my view, you've still got an expectation of a 30% decline in revenue in May, then you're not obliged to repay that wage subsidy. When you do become not eligible for it, though, if you don't have the decline in revenue in May or in June, then you are on an obligation to not let the Ministry of Social Development know about changes in your circumstances quickly. There was another one which was, hi Ian, in your example 2, which is my use of money interest and late payment penalty. 2019 terminal tax is due on 7th of April. Now, if a taxpayer is using tax pooling to pay the terminal tax, the latest tax date for tax pooling is actually, I think it's 75 days after a certain date, so it runs out in sometime in June. I think it's 15th of June or 7th of June, but we'll check that date. Is there any plans to extend the time frame that tax pooling can be used within as a result of COVID-19? Now, I know the tax intermediary companies, I think, have been pushing on this point. I personally haven't seen any change come through in respect of that at that date. There is maybe still time for that a change to be made in respect of that. So I think you have to watch this space and stay tuned on our regular COVID-19 updates. Mark, you haven't seen anything on that?
No, I haven't seen any more than what you've just said there, Ian. Sorry, I was just looking at another question, a fairly one that we see. It's a common question, and we've got it on our COVID-19 website. The question is around the wage subsidy again, and whether or not self-employed persons and small companies, your closely held companies, shareholder employees, can claim the wage subsidy. The answer is yes, you can. Clearly contemplates self-employed persons, shareholder employees are also eligible for that wage subsidy. And we've got a Q&A on our COVID-19 website on this point from memory. Sorry, Ian, I'm just firing through. There's another good question. If a business is trading under a trust and the owners in inverted commas are only receiving a trust distribution and no active income, which I assume is a reference to not really receiving a wage or a salary, are they eligible for the wage subsidy? I think my immediate reaction on this one is no. I don't know if you've got that employee-employer type relationship, which the rules are intending to capture. But again, Ian, you might have a thought on this.
I agree with you, Mark. And it's either I've read it in either one of our frequently asked questions on our COVID-19 site or in the IRD's website. So they regard a distribution from the trust as a discretionary distribution. It's not related to employment. It's not subject to wage subsidy.
Yeah. Sorry, Iain, you go.
Oh no, I'm just checking the time, see how we're doing.
Yeah.
So we are claiming R&D via Callahan Growth Grant. Can we claim R&D tax loss credit as well? So yes, you can. You can carry that. You can still claim the R&D tax loss cash up credit. What's not eligible is the R&D tax incentive, which is the new one at 15%, because it's specifically excluded if you've received a certain the Callahan grants.
Yeah. There's another question. Again, wage subsidy. What is the treatment if it straddles over 2 financial years? Will a proportion that relates to the future year be taxable? From an accounting perspective, yeah, my understanding is that you will split the wage subsidy between the two financial years. From a tax perspective, the wage subsidy is not taxable income. It's only taxable income to the recipient, the employee.
Unless you're shareholder, sole trader.
And then there's another one that's just immediately come in. Assume the 30% is a cut and dried question. Say you achieved 71%, i.e. you only experienced a 29% drop. You have to pay the full amount back. The answer is yes. It's a quite clear and cut and dried, as you say. It's if you've experienced, you need to experience a 30% drop to be eligible. Anything under that, and you don't meet the eligibility criteria.
Yeah, there's a couple of similar questions just before we start to wrap up. But the you know, the test is only for 1 month in that comparable section, or in the applications before 4 p.m. on the 27th of March, they had a 30-day period where you can compare it against 30 days against the same 30 days in the prior period. That seems to have been dropped out in the second statutory declaration, where it just refers to 1 month. But you don't need to have a 30% drop in revenue over all of the 12 weeks. You just need to suffer it once for one of those months, and you are eligible for the full 12 weeks. And what the point of the 12 weeks is you continue to employ those people. So I think we've got a couple of minutes. I just wanted to say thank you to Mark, my fellow presenter. Charlene might want to show his slide next. Thank you for all the questions. We will update our COVID-19 microsite with those questions. We have a series of seminars coming up each week at the same time to help you get back to being in business in this new normal environment. Next week we will have Taranesh doing one on resetting strategies, which is strategic decisions about where we're going to next is obviously a critical issue. Taranesh, our excellent presenter, did a great job last week on his earlier presentation. Next week is also Budget 2020, and it's hard to know what they will have left in the tank to release in terms of new changes, new tax changes, or new initiatives to keep businesses up and running in the budget. But that's next Thursday as well, and we'll be getting a communication out on the impact of the budget or certain key aspects of the budget in that time. So I hope you've enjoyed the webinar. Thank you, Mark, for your assistance. Thank you to Charlene and Jamie behind the scenes who have kept all the technology going really well. We wish you well in this lockdown, and hope you. I hope we get out into Alert 2 and Alert 1 really quickly, and we get back to supporting all our local businesses the way we want to best. Mark, do you want to say any concluding comment?
Same as you, Iain. Thanks to all, and in particular Jamie and Charlene for looking after us so well behind the scenes. So thanks all, enjoy your day and speak soon.